Let's take it over to CME Group now for today's Market Movers with easy-to-follow futures and options trades.
Welcome to Market Movers. I'm Jim Urio, and today we're talking about crude oil and its outlook for 2018. Now, the dollar's been weak the last couple months, but a global recovery seems to be gathering steam. We're looking at using CME WTI crude options as a way to hedge or create additional exposure against potential volatility. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, let's go over the influences of crude. We have the dollar. We have the global recovery. We have increased U.S. production once it got above
fundamentals,
60.
sure.
What's the most important thing pushing crude around?
Well, I knew you were going to ask me that. You've always asked the tough questions, Jim.
Right.
I want the layups, the softballs. It's actually all three. Now, what I think is fun about crude, if you want to say fun, is that crude reacts to those things separately, almost like they're mutually exclusive of each other. So depending on what crude is focusing on this week or this month is the key. To me, it's the dollar, because the dollar's been in the news
in
the
months
most.
past, we talked about the OPEC countries going through with their production cuts to try to support it. We haven't heard about that in a long time. Is that gone? Is that still going on?
It's gone for now, but you mentioned something earlier, which is fundamentals of crude, U.S. crude especially, which is obviously growing, getting stronger. Our export options with respect to crude are very good. So to me, the fundamentals could almost take over what's been going on overseas.
Got it. Now, before we dive into our trade discussion, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Price and movements will vary. The May contract in crude's trading 61.08 when we talked about this. Scott.
Yes, so listen, crude has been a fun one to look at, like I mentioned in the last few months, because of the fact that I think crude gives you some options with regard to the movement that it has on certain breakouts or breakdowns. And specifically, Jim, I was looking today at the charts, and this is mainly just really a chart play, actually, based on the volatility that's going on in ES and ZN and now CL. Looking at buying the May 59.58 put spread for 29 ticks. Now, this expires April 17th, even though it's the May contract. The underlying, as you mentioned, is about 61.08. It risks 290 to make a potential 710 if it fills out the whole spread. Now, here's the thing. I talked about the chart. If you look at the fact of crude, bouncing down or coming down from, say, the highs in late January and then rebounding as it has in the last, say, couple weeks as the market's kind of calmed down, the volatility's come down, it retraced almost 50% of that move. So to me, that just recently failed a couple days ago, and so it makes sense that we're going to see maybe a retest of some of those lows that we saw earlier in February. That's why I like this put
Now,
spread.
twice in the last 2 minutes, you seem to equate crude's movement with the stocks. Is crude a risk-on, risk-off asset like the stocks are? When the stocks went lower, is that why we sold crude in your opinion?
I believe so, because I think we've seen that in other asset classes too, is when equities feel pressure, especially as they did when volatility ticked up. You know what you saw? You saw it bleed in other asset classes.
Okay, I'm looking at the other way, as is usually the case
Shocker.
with you and I think crude, I think the global recovery is real. I think the dollar, if it threatens with the 88 level, could go lower and crude would spike higher on that. So I'm looking at buying the May, same contract as you're looking at, same expiration, goes off April 17th, the 64.65 call spread for 26 ticks. It risks 260 to make a potential 740. Now, I like this. If you look at it and say you have 2 months on this, is crude could it be $3 higher, $3 lower? The answer to that is absolutely yes.
That's true.
So to me, to get this for 26 cents out of $1, to me seems like a good move. You.
Or both trades. Because that's the other thing. Both expressions can give you that nice risk reward if there's some volatility in crude, which if you just look at the last 3 or 6 month charts, there's tons of it.
It's been flying on. There's volatility in a lot of different things.
That's right.
Last question. Is there a dollar level below which you worry about the dollar spilling out and that inverse correlation picking up again?
It's probably around 88, and then we saw from the Fed minutes today from the meeting, it looks like they're willing to be, goodness gracious, dovish again potentially if the market gets pressurized.
Unbelievable.
Holy cow.
I agree with you on that 88 level. Thanks for joining us on Market Movers. I'm Jim Urio, where we're hoping to make you a better trader.